Do you have investments in the Australian stock market? A super fund? Then this video is for you. Most people think their super funds or shares are only affected by the Australian economy, but the reality is much more complex. Today, I'll be discussing how global economic risks, from US interest rates to China's property crisis, and from geopolitical tensions to climate change, impact your investments right here in Australia. This video is not financial advice. The aim is to help you understand economic connections so you can make informed decisions. Let's get started. Australia's global connections. First, let's understand this. Australia's not an isolated economy. We have deep global dependencies. Take our trade partners. 35% of Australia's exports go to China, mainly iron ore, natural gas, and agricultural products. Another 15% goes to Japan, 10% to South Korea, and 6% to the US. What this means is, if China's economy slows down, Australia's largest companies, like BHP, Rio Tinto, and Fortescue, are directly affected. Then there is financial market integration. Foreign investor participation on the ASX is over 40%. When Wall Street sneezes, the ASX catches a cold. This isn't just a saying, it's a real correlation. Because Australia often runs a current account deficit, we are dependent on foreign investment. When global risk appetite decreases, the Australian dollar falls and our markets come under pressure. We saw this clearly during the 2008 global financial crisis. Even though our banking system was solid, the ASX fell 40% due to global panic. Your super funds, especially those in growth options, saw their balances decrease significantly. U.S. economy and Fed policies. Now let's look at one of the biggest risks. The United States. The U.S. is the world's largest economy, and the dollar is the global reserve currency. Therefore, the Federal Reserve's decisions affect everyone. When the Fed raises interest rates, U.S. Treasury bonds become more attractive. Global capital flows toward the U.S. and away from emerging markets, including Australia. This causes the AUD to USD exchange rate to fall and puts the ASX under pressure. We saw this in 2022 and 2023. When the Fed began aggressive rate hikes, the Australian dollar fell from 75 cents to 63 cents. Tech stocks like Afterpay and WiseTech were hit hard, and bond funds experienced major losses. Conversely, when the Fed lowers rates, the dollar weakens, risk appetite increases, and the ASX generally strengthens. Most super funds invest between 20 to 40% in international assets. This means Fed policies are indirectly, but significantly, affecting your retirement savings. China's economy, our largest trading partner. China is the most critical factor for Australia's economy, and right now, China is facing serious structural problems. First is the property crisis. Giant construction companies like Evergrande and Country Garden have collapsed. Since the property sector made up nearly 30% of China's GDP, the demand for construction materials has plummeted. This puts Australia's iron ore exports at major risk. Additionally, China faces deflation risks, weak consumer demand, and youth unemployment over 20%. When domestic demand in China weakens, they import less from us. Combined with ongoing U.S.-China tensions and technology sanctions, the direct impact on Australia is clear. Mining stocks make up approximately 20% of the ASX 200. If you have an Australian shares-heavy option in your super fund, you have significant indirect exposure to the health of the Chinese economy. Geopolitical risks. Economics isn't just about numbers. Political events can instantly impact markets. Currently, the Ukraine-Russia war continues to make energy and food prices volatile. Since Europe takes about 7% of our exports, a European recession reduces demand for Australian goods. In the Middle East, tensions cause oil prices to spike. Even though Australia is a net energy exporter, high global energy prices increase inflation here at home. This can force the RBA to raise interest rates, leading to increased mortgage repayments and lower consumer spending. Perhaps the biggest risk scenario is the Taiwan issue. Taiwan produces 60% of the world's semiconductors. Any conflict there would stop the global technology supply chain, causing ASX tech and industrial companies to take a major hit. Geopolitical shocks are sudden and unpredictable, and they can reduce superbalances by 10 to 30% in a very short time. Climate change and energy transition. We can no longer ignore climate change when discussing financial risk. For Australia, physical risks are a reality. Events like the Black Summer bushfires or the 2022 floods hit insurance companies like IAG and Suncorp, increase infrastructure costs, and reduce agricultural production. There are also transition risks. Australia is a world leader in coal and natural gas, but the world is moving away from fossil fuels. Europe aims to phase out coal by 2030, and China is investing aggressively in renewables. This puts energy stocks like Woodside and Santos under long-term pressure. Many super funds still carry 5 to 15% fossil fuel exposure. These are now considered stranded assets that could become worthless as the global economy decarbonizes. This is why regulators like APRA now require super funds to report their climate risks. Inflation and interest rate risks. Now, let's talk about the risk you feel most closely: inflation and interest rates. The global inflation wave between 2021 and 2024 was driven by post-COVID supply chain issues, excessive monetary expansion, and the war in Ukraine. In Australia, inflation hit a 30-year high of 7.8% in 2022. The RBA responded by raising the cash rate from 0.1% to 4.35%. This caused mortgage repayments to jump by 50 to 80%. On the ASX, high interest rates cause growth stocks in tech and biotech to fall. While financial stocks like the Big Four banks generally perform well, real estate investment trusts come under pressure. In 2022, many balanced super funds experienced losses of 8 to 12% because both their equity and bond holdings lost value simultaneously. Systemic risks, banking and the financial system. Finally, the least visible but potentially most dangerous risks. Systemic financial risks. The 2023 collapse of Silicon Valley Bank and Credit Suisse caused ASX banking stocks to drop nearly 10% almost overnight. While Australian banks have strong capital positions and tight regulations, they are not immune. Our banks borrow from international wholesale markets and deal with global investment banks. If a global liquidity crisis occurs, Australia cannot remain isolated. Since the Big Four banks make up 25% of the ASX 200, a global banking crisis would directly and heavily affect your super balance. How your super funds are affected. Overview. To summarize, let's look at a typical balanced super fund. It usually holds 55% in equities, 20% in bonds, 10% in property, 10% in infrastructure, and 5% in cash. Each of these is exposed. Equities are hit by Fed policies and China's economy. Bonds, once thought to be safe, lose value when interest rates rise. Property is sensitive to both rates and climate risk. Historically, super is resilient. Balanced funds fell 25% during the GFC and 15% during COVID, but they recovered. The most important thing to remember is that super is a long-term investment. Short-term fluctuations are generally made up over a 30 to 40-year time frame. Closing. In an interconnected world, no economy is an island. From the Fed in Washington to the property markets in Beijing, global risks are your risks. Knowing this isn't about panicking, it's about being informed. Your super is managed by professionals, and diversified portfolios are designed to handle these storms. Take the time to check your statements, understand your asset allocation, and assess your own risk tolerance. If you're unsure, consult a licensed financial advisor. Keep following the developments, stay informed, and stay well.